In corporate finance, free cash flow is a way of looking at a business's cash flow to see what is available for distribution among all the securities holders of a corporate entity. This may be useful to parties such as equity holders, debt holders, preferred stock holders, convertible security holders, and so on when they want to see how much cash can be extracted from a company without causing issues to its operations. The free cash flow can be calculated in a number of different ways depending on audience and what accounting information is available. A common definition is to take the earnings before interest and taxes, add any depreciation and amortization, and then subtract any changes in working capital and capital expenditure. Depending on the audience, a number of refinements and adjustments may also be made to try to eliminate distortions. The free cash may be different from the net income for a particular accounting period, as the free cash flow takes into account the consumption of capital goods and the increases required in working capital. Calculations: the free cash flow can be calculated as follows. Note that the first three lines above are calculated for you on the standard statement of cash flows. When net profit and tax rate applicable are given, you can also calculate it by taking, where, net capital expenditure, CAPEX, equals CAPEX, depreciation and amortization, tax shield equals net interest expense x effective tax rate, when PAT and debit equity ratio is available, where D, is the debt equity ratio. For example, for a 3-4 mix it will be 3/7. Therefore, difference to net income: there are two differences between net income and free cash flow. The first is the accounting for the consumption of capital goods. The net income measure uses depreciation, while the free cash flow measure uses last period's net capital purchases. The second difference is that the free cash flow measurement deducts increases in net working capital, where the net income approach does not. Typically, in a growing company with a 30-day collection period for receivables, a 30-day payment period for purchases, and a weekly payroll, it will require more and more working capital to finance the labor and profit components embedded in the growing receivables balance. The net income measure essentially says, you can take that cash home, because you would still have the same productive capacity as you started with. The free cash flow measurement, however, would say, you can't take that home, because you would cramp the enterprise from operating itself forward from there. Likewise, when a company has negative sales growth, it's likely to diminish its capital spending dramatically. Receivables, provided they are being timely collected, will also ratchet down. All this deceleration will show up as additions to free cash flow. However, over the longer term, decelerating sales trends will eventually catch up. Net free cash flow definition should also allow for cash available to pay off the company's short-term debt. It should also take into account any dividends that the company means to pay. Net free cash flow equals operation cash flow (euro capital expenses to keep current level of operation (euro dividends (euro current portion of long-term debt (euro depreciation). Here CAPEX definition should not include additional investment on new equipment. However, maintenance cost can be added. Dividends: this will be base dividend that the company intends to distribute to its shareholders. Current portion of limited: this will be minimum debt that the company needs to pay in order to not create defaults. Depreciation: this should be taken out since this will account for future investment for replacing the current PPE. If the net income category includes the income from discontinued operation and extraordinary income, make sure it is not be part of free cash flow. Net of all the above give free cash available to be reinvested on operation without having to take more debt. Alternative mathematical formula: FCF measures operating cash flow, less expenditures necessary to maintain assets, but this does not include increase in working capital. Less interest charges, in symbols. Where OCBT is the firm's net operating profit after taxes during period T, it is the firm's investment during period T including variation of working capital. Investment is simply the net increase in the firm's capital, from the end of one period to the end of the next period. Where KT represents the firm's invested capital at the end of period T. Increases in non-cash current assets may, or may not be deducted, depending on whether they are considered to be maintaining the status quo, or to be investments for growth. Unlevered free cash flow is defined as EBITDA, capex, changes in net working capital, taxes. This is the generally accepted definition. If there are mandatory repayments of debt, then some analysts utilize levered free cash flow, which is the same formula above, but less interest and mandatory principal repayments. Investment bankers compute free cash flow using the following formulae: FCFF equals after-tax operating income plus non-cash charges, capex, working capital expenditures plus interest, 1T, equals free cash flows to the firm, FCFE equals net income plus non-cash charges, capex, change in non-cash working capital plus net borrowing equals free cash flows to the equity, or simply, FCFE equals FCFF plus net borrowing, interest, 1T. Uses of the metric: free cash flow measures the ease with which businesses can grow and pay dividends to shareholders. Even profitable businesses may have negative cash flows. Their requirement for increased financing will result in increased financing cost, reducing future income. According to the discounted cash flow valuation model, the intrinsic value of a company is the present value of all future free cash flows, plus the cash proceeds from its eventual sale. The presumption is that the cash flows are used to pay dividends to the shareholders. Bear in mind the lumpiness discussed below. Some investors prefer using free cash flow instead of net income to measure a company's financial performance, because free cash flow is more difficult to manipulate than net income. The problems with this presumption are itemized at cash flow and return of capital. The payout ratio is a metric used to evaluate the sustainability of distributions from REITs, oil and gas royalty trusts, and income trust. The distributions are divided by the free cash flow. Distributions may include any of income, flowed through capital gains or return of capital. Problems with capital expenditures: the expenditures for maintenance of assets is only part of the capex reported on the statement of cash flows. It must be separated from the expenditures for growth purposes. This split is not a requirement under GAAP, and is not audited. Management is free to disclose maintenance capex or not. Therefore, this input to the calculation of free cash flow may be subject to manipulation, or require estimation. Since it may be a large number, maintenance capex's uncertainty is the basis for some people's dismissal of free cash flow. A second problem with the maintenance capex measurement is its intrinsic lumpiness. By their nature, expenditures for capital assets that will last decades may be infrequent, but costly when they occur. Free cash flow, in turn, will be very different from year to year. No particular year will be a norm that can be expected to be repeated. For companies that have stable capital expenditures, free cash flow will be roughly equal to earnings. Agency costs of free cash flow. In a 1986 paper in the American Economic Review, Michael Jensen noted that free cash flows allowed firms' managers to finance projects earning low returns, which therefore might not be funded by the equity or bond markets. Examining the U.S. oil industry, which had earned substantial free cash flows in the 1970s and the early 1980s, he wrote that the 1984 cash flows of the 10 largest oil companies were $48.5 billion, 28% of the total cash flows of the top 200 firms in Dunn's Business Month survey. Consistent with the agency costs of free cash flow, management did not pay out the excess resources to shareholders. Instead, the industry continued to spend heavily on exploration and development activity even though average returns were below the cost of capital. Jensen also noted a negative correlation between exploration announcements and the market valuation of these firms, the opposite effect to research announcements in other industries. See also, business valuation, discounted cash flow, enterprise value, economic value added, owner earnings, weighted average cost of capital. References: Brearley, Richard A. Myers, Stuart C. Allon, Franklin. Principles of Corporate Finance. Boston, McGraw-Hill Irwin. ISBN A0-07-295723-9. Jensen, Michael C. Agency Costs of Free Cash Flow, Corporate Finance and Takeovers. American Economic Review 76, 323 Euro 329 doi, 10.2139/SSRN 99580 Stewart, G. Bennett, 3. The Quest for Value. New York, Harper Business. ISBN A0-88730-418-4. External links, Free Cash Flow, free, but not always easy, Investopedia, What is Free Cash Flow? Morningstar.